Have you felt the rising cost of living lately?
It's very clear our economy is still in trouble.
What if I told you the Federal Reserve might play a big role in changing that? Do you know how the Federal Reserve's decisions influence your job, loans, and even your grocery bills? Economists forecast that the Federal Reserve of the United States will deliver a critical decision this week, with the lowering of interest rates for the first time in more than 4 years. While there has been no official announcement by the Federal Reserve yet, there is a strong prior precedent of analysts accurately predicting the Reserve's next moves. The cuts by the Reserve affect everything from your loans to credit card interest rates to mortgage payments. For instance, while the prices of properties may remain at record high values in most places in America, it may be easier to get a loan for a house payment. Rates for private loans may also come down after the announcement of the cut in rates. The Federal Reserve also has major influence over your purchasing power as a consumer. In the wake of the coronavirus pandemic, low interest rates meant to boost the economy and the job market fed demand to the point where supply is unable to keep up. The economy is deeply interlinked with the decisions made by the Reserve. So everything from how secure you feel at your job to your living cost is dependent on their decisions. The Federal Reserve can be understood as the most powerful economic institution in the United States. The Reserve is responsible for regulating the U.S. financial system. It accomplishes this by determining interest rates, affecting the amount of money in the economy, and, in recent years, purchasing assets worth trillions of dollars to strengthen the financial markets. So, why is the Federal Reserve making this decision right now? As you may have noticed, the economy has been on a downward trajectory. Fears of a recession have led to economists calling for cuts to be announced earlier. Layoffs may be rare, but hiring has slowed down, making it more difficult for the unemployed to find employment. The pandemic was a major global economic disruption in 2020. In response, the Federal Reserve proposed a number of steps to support markets and inject cash into the financial system, including cutting rates to zero. The economy recovered more quickly than it had after the Great Recession. Nonetheless, the boost brought the biggest inflation rate since the early 1980s, along with reduced demand due to the lockdown, tangled supply chains, and high global oil costs after Russia invaded Ukraine. The Federal Reserve has been trying to prevent a recession by cooling the economy with interest rate hikes in this climate, deploying a strategy known as a soft landing. Still, unemployment continues to rise. The number of open positions is at its lowest point since 2021. Housing affordability has been reduced because of rising mortgage rates and skyrocketing property values. The head of the Federal Reserve and other decision makers maintain that the job market and the economy as a whole still reflect the robust circumstances observed before the outbreak. Many members of the committee think that the risks associated with inflation and the labor market are currently about equal. Nonetheless, the interest rate curve, which monitors market speculation over rate movements in the future, projects that borrowing costs will decrease from the current 5% to below zero in 2025. As the Federal Reserve is set to meet on Wednesday, the question which remains is, by how much will interest rates be cut? In the wake of decreasing inflation and a stagnant job market, the effects of any decision will trickle down to all parts of the economic framework, which will surely have a direct influence on your life.